Good afternoon to everyone. A very warm welcome to all the distinguished guests, member of the profession, industry representatives, tax professional, and participants joining us from India, Singapore, and other part of the world. My name is C. Animesh Mangal, and I am delighted to be the moderator for today's session. On behalf of the International Taxation Committee of the Institute of Chartered Accountants of India and the ICI Singapore chapter, it gives me immense pleasure to welcome you on today's webinar, which is on India-Singapore Investment Corridor, Tax Reform and Emerging Regulatory Developments. The India-Singapore economic relationship continues to one of the strongest strategic partnership in Asia Pacific region. Before we begin, I would like to acknowledge the presence of our esteemed dignitaries. We are grateful to all of them for sparing their valuable time and enriching this forum with their insights. May I now invite CS Sanjay Gadani sir, Chairman ICI Singapore chapter, to deliver the opening remarks.
Thank you so much. Thank you, Animesh. Respected High Commission Sir, Shri Satish Kumar Gupta ji, CA Vishnu Agarwal ji, Kalpana ma'am, welcome to this historic, distinguished guests, colleagues and members of the profession. Good evening. It is an honor to welcome all of you to today's webinar, jointly organized by ICAI Singapore chapter, ICAI International Affairs, the Income Tax Department of India, and more in association with High Commission of India. Today, we gather at a historic economic juncture at the India-Singapore Investment Corridor. Singapore has long served as a vital gateway for
Animeji, I think some technical problem. So you just go ahead for the next.
Thank you so much, Sanjay sir, for thoughtful remark. It is now my privilege to invite CA Vishnu Kumar Agrawal ji for welcome address. Before I invite Vishnu sir, I would like to introduce sir. CA Vishnu Kumar Agrawal ji, Central Council member of ICI, presently serve as chairman of the Peer Review Board and vice chairman of the International Taxation Committee. With more than 2 decades of rich professional experience, he has developed deep expertise in search and survey proceeding, Benami and black money matters, income tax litigation, and appellate proceeding before various authorities, including the ITA. His experience and leadership within the ICI have contributed significantly towards strengthening professional excellence and tax awareness among members. With these words, may I respectfully request CA Vishnu Kumar Agrawal ji to deliver the welcome address.
Let us give Sanjay.
Yes.
Sanjay, please complete your.
Sanjay ji, please complete, sir. Sanjay Gattani ji?
No, it's some issue there.
No problem, sir. No problem. Thank you, Animesh ji, for good words. Very highly respected Silpak Ambole ji, the Indian Foreign Services IFS High Commissioner of India to Singapore. Respected Madam Kalpana Singh ji, IRS CIT Transfer Pricing 3 at Delhi. Our respected chairman of the International Tax Committee, Satish Gupta ji, Central Council member, my colleague in the council, Sanjay Kattani ji, again the respected chairman of the Singapore chapter, Kushal Jaju ji in absentia, vice chairman of the chapter, today's speaker Gaurav Singhal ji, Manoj Kumar ji, and my dear friend moderator Animesh Mangal ji. Ambole sir, firstly, we are very much thank you to sparing your valuable time for the profession, and we understand your valuable significance towards the India. Sir, first I introduce what is the ICI. Sir, we are 5 lakh chartered accountant across the world. Out of 5 lakh chartered accountants, sir, we are 1 lakh 50,000 chartered accountant in the practice. My 3 lakh chartered accountant with the various industries. My 20,000 chartered accountants, sir, we are serving out of India like Singapore and Middle East and each and every part of the world. Sir, my 10,000 chartered accountant with the various government services in which 1,000 chartered accountant are the IAS, IRS and the IPS, and they are serving the nation building. Sir, rightly said by the APJ Abdul Kalam in the speech that ICI is a nation partner building. Sir, as we are as a bridge between the government and the stakeholders and serving as India in the various significant mode as a MSME, income tax, GST, and whether other various stakeholders, sir. Sir, today is the topic in India-Singapore investment corridor, tax reforms, and emerging regulatory development. This today's webinar will be highly benefited by each and every stakeholders today is a participating in this particular webinar. Sir, we are once again thankful to you and Kalpana ma'am for sparing your valuable time towards the profession. With these words, I thanks to my each and every dignitaries to joining this particular webinar. Jai Hind.
Thank
Sanjay,
you very
can
much,
now complete your one. Sanjay Gattani ji, please. Unmute.
Sorry. I guess if I may start again, we lost a connection here. So as I was saying, today we gather here for an historic economic investment corridor. Singapore has long served as a vital gateway for global capital flowing into India. Today, this corridor is being profoundly defined on the onset of India's anticipated new Income Tax Act. This landmark legislative overhaul marks a decisive shift from the legacy complexities, replacing them with streamlined digital first framework designed to provide unparalleled tax certainty, minimize litigation, and completely modernize the international tax compliance. For cross-border investors, corporate leaders, and professional advisories, mastering these emerging regulatory dynamics is no longer optional. It has become a strategic necessity. Over the next 2 hours, our eminent speakers will dissect the sweeping statutory changes, offering deep operational insights to help one navigate the sophisticated cross-border landscape. I wish all the best to all the speakers and thank you once again. Thank you to the High Commission, sir. Thank you, Kalpana ma'am. Thank you, Satish Agarwalji, and the entire International Taxation Department. And definitely, we can't forget the blessing of the President, sir, of ICAI. Thank you so much.
Thank you so much, Vishnu sir and Sanjay sir, for their address and setting the perfect context for today's seminar. It is now my honor to invite CA Satish Gupta sir for keynote address. CA Satish Gupta sir is currently serving as the chairman of the International Taxation Committee
Just
of the
save
ICI.
time. Let us save time, Animesh. I start. Good
Thank you.
evening to each one of you. And I am reminded to Director Shilpak Ambuleji when I, along with the President, ICI visited recently to Singapore. And sir, we are heartily thankful to you for your hostship and for the what we got here, sir, the love and affection. So thank you very much, sir. Thanks a lot. And we have with us Madam Kalpana Singh, Honorable CIT Transfer Pricing 3 Delhi, and we are thankful to Madam also, Madam that is sparing time for us for this webinar and agreeing to give a special address on India-Singapore tax system on the topic. So thank you very much again. We have with us Sanjay Gattani ji, chairperson of the Singapore chapter of ICI. Kushal ji is not here, but Vishal ji is here. And other management committee members, Gaurav Singhal ji, Manoj Kumar ji, learned speakers, C. Animesh Mangal ji, moderator of the day, and my dear friends who are attending in a very large number this webinar. Definitely it is historic because I think as on the platform of International Tax Committee, it is first one where we are doing the webinar jointly with Singapore chapter. So definitely historic also because High Commission of India in Singapore, Honorable Dr. Shilpak Ambuleji himself is present and has agreed to address all the members of the profession. So, and I have seen the knowledge and the interest he has shown in the profession when we met with him. So, friends, it is really an opportunity to listen Ambule sir. It's a really wonderful thing. Friends, International Tax Committee has always focused on building knowledge and the strengthening of professional capabilities of members in the field of international taxation. In line with this objective, we regularly organize programs on topics that are relevant, practical, and important for professional practice. Friends, in this line, I would like to say that as of now, we have 3 courses in the International Tax Committee. One is the post-qualification diploma in international taxation. Second one is the tax system of United States of America. And third one is the UAE corporate tax system. The 2 are the certificate courses and one is the post-qualification diploma. These 3 courses are well being accepted by the members of the profession, and recently we have got approved from our council the tax system certificate course on tax system of United Kingdom. And I am happy to say that we are also working on a certificate course on tax system of Singapore, Malaysia and Australia. So today we are with the Singapore chapter, and it is a matter of pleasure and privilege for me to say that we are also working on the Singapore tax system, and we will bring this certificate course very soon. Apart from this, we are also working on various publications, and we are having several awareness seminars and conferences where we are focusing on that awareing our members about the tax jurisdiction of different tax jurisdictions. Friends, today's topic is on the India-Singapore economic investment relationship. I know that it has long one, and it is very significant strategic partnership in the Asia-Pacific region. Singapore continues to be a leading source of foreign direct investment into India, while also serving as a preferred gateway for Indian businesses expanding internationally. Over the years, the India-Singapore investment corridor has evolved considerably, driven by economic integration, changing business models, growing cross-border investments, and increasing regulatory cooperation between the 2 jurisdictions. At the same time, the international tax and regulatory landscape is undergoing rapid transformation. Recent tax reforms and regulatory developments in both India and Singapore have created new opportunities, while also introducing fresh compliance considerations for investors, multinational enterprises, and tax professionals. Therefore, an important question rises: how can investors, business, and tax professionals effectively navigate the evolving India-Singapore investment landscape while adapting to recent tax reforms and emerging regulatory developments? This webinar seeks to address these critical issues by providing practical insights into the changing tax environment, key regulatory developments, and regulatory framework governing investment between the 2 countries, and to understand their practical implications on business operations and investment planning. As businesses increasingly seek certainty, efficiency, and compliance in their cross-border activities, a deeper understanding of the India-Singapore investment ecosystem becomes crucial for identifying opportunities, managing risks, and making informed decisions. We are fortunate to have with us Madam Kalpana Singh, Honorable CIT Tax Transfer Pricing. I know that her special address shall definitely take care of how we should proceed in the right direction. And our speakers, CA Gaurav Singhal, a very senior speaker, and CA Manoj Kumar will definitely take care that how our members get value addition out of this webinar today. Friends, I encourage all the participants that live in the webinar till last and take full advantage of this session. And I assure you that after webinar, you will get a very big value addition to your knowledge about the international taxation, specifically in the light of the India-Singapore relationship. So thank you, Divya. Thank you, friend. Thanks a lot. Over to Animesh.
Thank you so much, Satish sir, for your visionary address. It is now my distinct privilege to introduce our guest of honor, Dr. Shilpak Ambule sir, High Commissioner of India to Singapore. Dr. Ambule belongs to the Indian Foreign Services and has served India with several important decisions. Since July 2023, he has been serving as the High Commissioner of India to Singapore, playing a vital role in strengthening one of India's most important strategic and economic partnership. Sir, we are deeply honored by your presence. With these words, may I now request Dr. Shilpa Kambale sir to kindly address the gathering.
Thank you so much, Mr. Animesh. I'm really happy that we are arranging this kind of interaction today for several reasons. Singapore has around maybe more than 600 foreign portfolio investors based here who invest in India. We have many HNIs based here, many prominent NRIs based here. As the earlier speaker mentioned that Singapore is one of the largest sources of FDI for India. Also, in the last 10-15 years, so many PE funds or pension funds, both Singapore-based as well as global pension funds, route their investments into India through Singapore. Be it the Canadian pension funds, be it the private equity funds of the US, all have their presence here and they route their investments into India through Singapore. And last but not the least, many Singaporean companies, both investment firms like GIC and Temasek, as well as other companies, are increasingly looking to expand their footprint in India. GIC and Temasek have openly said that they want to increase the share of their India portfolio. Other companies are looking to go into different states in India, are deploying more resources, both in terms of human resources as well as monetary resources into India. So from that point of view, this corridor becomes very, very significant and very important. As the question for everybody is, and we've been kind of grappling with this issue of tax uncertainty. But what we've done last year by passing the new Income Tax Act, what we did with GST a few years ago, what we have done with RERA, although not directly related to taxation, but these are some of the reforms we have undertaken where we have increased the ease of doing business and trying to remove the uncertainty part. So as we move from uncertainty towards certainty, I think this seminar is very, very apt and timely. And I think the best part is that most of the CAs are present here, chartered accountants based in Singapore, as well as chartered accountants based in India, as you play a very pivotal role in helping people address the tax issues or helping them adapt to the Indian taxation system. Singapore is important, is also evidence. You can find the evidence in our High Commission itself. We have two people, one from the revenue side, one from the custom side, from the government based here for a considerable amount of time now. So from that point of view also, we attach a lot of importance to these issues. And I'm very happy today that we've had such a big gathering here, both policymakers as well as people who implement the policy, as well as people who help investors and institutions understand our taxation environment. So I'm very happy that we are doing this today, and I wish the program a complete success. And I'm sure this is not the last time we do such kind of an event. And I am very happy to support and encourage any such future events, because I feel that each and every chartered accountant in whichever institution he or she is working in will play a pivotal role in telling people about how change is happening in India and how the taxation system is being simplified for everybody. So on that note, thank you very much for inviting me. I'm very happy to be present here. But even otherwise also, our office is always open. If anybody wants any assistance, any kind of help or any clarification, or want to do any other such event, we are more than happy to collaborate and support. Thank you.
Thank you very much, sir. Thanks a lot.
Thank you so much, sir. We really remain indebted for your support all the time.
Thanks. Thanks.
अनिमेश जी आप म्यूट हैं.
Thank you so much, sir. We are truly grateful for your guidance and encouragement. Now it is my pleasure to introduce Ms. Kalpana Singh ma'am, IRS Commissioner of the Income Tax. Ms. Singh belongs to the 2006 batch of the Indian Revenue Services and has nearly 2 decades of distinguished experience across tax administration, transfer pricing, international taxation, tax policy, legislation, investigation, and budget formulation. She played an important role in comprehensive review and simplification exercise leading to the enactment of Income Tax Act 2025 and Income Tax Rule 2026. With these words, ma'am, we are truly privileged to have you with us today. May I now request ma'am to kindly deliver the special address.
Thank you, Animesh. Respected High Commissioner of India to Singapore, Shri Shilpak Ambule, First Secretary ITOU, Shri Sanyam Joshi, President of ICI, Shri Prasanna Kumar, Vice President of ICI, Shri Mangesh Kinare, Chairman of ICI Singapore Chapter, Shri Satish Kumar Gupta, Shri Sanjay Gatani, Chairman ICI Singapore, Shri Vishnu Agarwal, Vice Chairman, all the distinguished members of International Affairs and International Taxation Committee of ICI, all other members of ICI who have joined this webinar, officers of the Indian Mission, esteemed taxpayers, investors, and friends, a very good evening to you all. At the outset, I would like to congratulate the ICI Singapore chapter who has collaborated with the Indian High Commission and ITOU and the ICI India chapter to conduct this collaborative webinar. You are truly bridging borders and serving as vital partners with the Government of India in building a tax ecosystem which is anchored in mutual trust. Today's program has a profound significance for both India and Singapore, as both have been pillars of an unbroken investment dialogue for decades. As mentioned by Shri Vishnu Agarwal ji and also the High Commissioner, a substantial portion of India's cross-border investments, the multinational operations, transfer pricing allocations, and international financial structuring is routed through Singapore. It is no wonder that Singapore contributes to almost about 24 to 25% of the FDI in India. This places Singapore at a central position in India's international tax architecture too. Any forward-looking tax administration endeavors to place trust on three fundamental pillars of governance. The first one being certainty, the second one being simplicity, and the third one being the rule of law. The theme of today's program, Tax Reform and Emerging Regulatory Development, captures exactly the essence of what the modern tax administration is aiming at. As mentioned by Shri Ambule sir, in the past, various measures have been made keeping this aim in sight while ushering in legislative reforms as well as in easing the regulatory compliances for the taxpayers as they are partners in nation building. Today, we stand at a historic inflection point as the direct tax administration, the legislation has moved from the iconic Income Tax Act 1961, which served the nation for about 64 years. And as we are stepping into a modern era of Income Tax Act 2025, followed by the Income Tax Rules 2026, I will briefly take few minutes to talk about how this transition has happened and what, why, and how of it, just to put things in the right perspective. The chartered accountant community knows that the income tax law serves as a primary tool for the government to drive social change, encourage investments, and curb illicit practices as well as plug revenue leakages so as to garner requisite revenue for running the nation. Whenever global or domestic financial environments have shifted, tax laws have been updated to reflect these policies. The Income Tax Act 1961 was originally drafted for an economy and the taxpayers measured in hundreds of crores. Today, India is a more than a $4 trillion economy. And the income tax law is a live and dynamic law because it is a unique piece of legislation and probably one of the few live laws which undergoes annual amendments every year through the Finance Acts. This is done to keep pace with the rapid changes in the global economic sphere, the government policies, and the judicial interpretations, as well as to meet the requirements of an aspiring population of India. Over a period of 6 decades, the 1961 Act had underwent 65 major overhauls and more than 4,000 individual amendments through annual finance acts to cater to this process of nation building. Various exemptions and deductions were brought in to support socio-economic goals such as encouraging investments, boosting exports, promoting balanced growth, and advancing social equity. These provisions included benefits for export incomes, investment in specific sectors or regions, and spending on rural development, as well as boosting economic development through a targeted approach. While these changes have kept the law relevant, they have also made the law cumbersome and difficult to read, with a lot of cross references, with a lot of provisos built in to cater to certain specific scenarios, and a lot of non-obstante clauses. So this was leading to a lot of complexity in compliance as well as increased source of litigation. Realizing this issue, in July 2024, the Honorable Finance Minister announced the government's intent to overhaul the Income Tax Act 1961 with the aim of simplifying its language, making it lucid and concise and readable for a normal taxpayer to read it, as well as to eliminate the outdated provisions. The CBDT set up an internal department committee to take this task ahead. This was done not in isolation in the tax department, but it was done in a Jan Bhagidari mode. The committee invited suggestions from all stakeholders, including industry bodies, professional associations, the ICI, its various chapters, field officers in the income tax department. Public suggestions were also invited to the e-portal of the income tax department. After doing this extensive consultation and brainstorming exercise, the Income Tax Act came into effect from the 1st of April of this financial year, 2026. Here, I would like to emphasize the core guiding principle that have been behind the monumental shift to this new law. The objective was not to alter any tax rates or any major policy decisions or the fundamental incidence of tax, but the objective was to simplify the law and place trust on the taxpayer. Therefore, it is not an overhaul of the tax law per se, it is an overhaul of the tax experience. To reframe the income tax law, there were 5 guiding principles. I will briefly talk about them. The first one was simplification of the language, including simplification of the structure. There were various scattered provisions relating to same subject but lying at different places in the Act, and cross-referencing for the tax administration as well as the professionals was really difficult. So the first one was to simplify and put in a more robust structure and easier to read language. Secondly, the simplification exercise was planned in a way that there were no major policy shifts. So the certainty and predictability was preserved. Fourthly, we aimed at removing the redundancies. Over a period of time, the provisions which had been brought for certain socio-economic development had outlived their utility, but they were still finding place in the statute book. So therefore, those redundant provisions were removed, and they were also making the law bulky. Fifthly, we reorganized the structure of the Income Tax Act into a schema where the provisions relating to a single head of taxation like TDS or salary or exemption, they were put in place together, and it makes it more easy to read. Most importantly, one major change was doing away with the concept of previous year and assessment year, because for a regular taxpayer, it was a very confusing concept. So we have brought in the concept of tax year, which relates to a unified unit, single unit of the financial year commencing on the 1st of April of each financial year. In a nutshell, I will just briefly give the statistics also as to what this kind of restructuring looks like. So from 1819 sections in the 1961 Act, we have moved to 536 sections in the new Act. 47 chapters have been converged into 23 chapters. Similarly, 511 rules are now brought into 333 rules, and out of 399 compliance forms, major pruning has been done, and now we have 190 compliance forms. Coming to the international tax aspect of the changes, this especially relates to the procedural compliances, bringing about the ease of compliance and making it easier for the non-resident and our foreign companies to file their compliances. The design, the fundamental design philosophy, which was kept in mind by the committee, was firstly to reduce the compliance burden. This was done by standardization of certain common elements across the forms. Secondly, the theme which was kept in mind was enhancing the voluntary compliance. So a lot of forms will now be having auto-filled and pre-filled data, and I hope, I'm sure that this will aid in the voluntary compliance. Thirdly, we targeted boosting the operational efficiency, as many of the forms were not readable by our machines. So the data was not in a structured format, which led to more queries from the department side and difficulty in filling up the forms from the taxpayers and professional side. So the data is now captured in a more structured tabular format. Fourthly, we targeted on minimizing the litigation. So the removal of complexity also leads to removal of ambiguity, and that is the thought which was kept in mind. Wherever there was some term which was not clear, endeavor was made to make it simple to understand. Formulae have been put in place, tables have been put in place for the ease of compliance, for the ease of calculation. A few highlights in respect of the forms which relate to international taxation. One major form is the form for filing of remittance, Form 15CA and Form 15CB. So this is now converted to Form 145 and 146. And a lot of changes have been made therein. Duplication has been removed, and the taxpayers who have obtained a certificate from the chartered accountant need not file the Part C of the Form 15CA. We have introduced capturing of the ITD REN of the authorized dealer, as well as the UDIN for the chartered accountants who have provided the accountant's report. So this is also a step ahead in preventing fraud, which was in few cases we observed that it was being misutilized. Then a major form for international taxation is the transfer pricing accountant's report, that is the form 3CEB. So this form has been majorly overhauled. It is now better structured, and the transactions have been identified. They have been jotted down. So proper capturing of the data will not only lead to better risk management, but it will also reduce compliance burden, because the low risk cases will no longer find themselves responding to TP audits. Then the coming to the advanced pricing agreement forms, this is a step in honoring the forthcoming taxpayers who are opting for the APAs. So a separate renewal form has been provided, because the forms, same form was available for application, rollback, as well as renewal. Now a separate form is available for renewal. So the department can fast track it. It does not get lost in amongst the other forms. The rollback application and the main application form has been merged into a single form. So this will expedite in the processing of our APA applications. The safe harbor forms have been merged into a single form. Similarly, the forms for both for advanced rulings, they have been made enabled for online filing. Now, coming to the aspect of creating awareness amongst the taxpayers as well as the professional community from the department side, I would like to say that while we are recognizing that the standardization of the code, the department has made taken various steps to launch outreach programs to provide information and material. We have rolled out exhaustive brochures and pamphlets on there are 9 brochures international tax forms going from CBCR to APA to MAP and various other forms. So the guidance notes and FAQs on each of the forms are available on our website. I would request the chartered accountant community to generate awareness about this. The department is also reaching out to the stakeholders through various uh, multimedia campaigns, like we are running an animated bite-sized tutorial videos on our YouTube, on our Instagram, on our X platform and the channel of the department. And they are animated series which explain various changes that have been made. We also have some vast session with our officers, which have captured the details of the changes made on various subjects. And we have a very interesting chatbot called Karsathi, which has been launched. The Karsathi is a 24/7 assistant which is available, and it is like a digital companion. It responds to queries, and I'm sure it will help the child accountant fraternity to troubleshoot any navigational errors or cross-verify deadlines, and as well as map new sections with the older ones. Now, coming to the progress that has been made on the regulatory side, especially given the India-Singapore ties, we have made a great stride in our APA program. The financial year 25-26 was a milestone year for the APA program of India, and we had a record signing of 219 APAs. This comprised of 84 bilateral APAs and 135 unilateral APAs. We also reached a record of 1,000 APAs having been signed since the inception of the APA program. And this landmark milestone is not just a statistical achievement, it actually represents a profound shift towards a cooperative dispute prevention. The Income Tax Department has been successfully moving away from a prolonged multi-year litigation, and we are heading towards an upfront binding tax certainty through the APA program. Similarly, we have expanded the ambit of our safe harbor rules through recent updates. So a major threshold limit for the safe harbor applications has been raised to 2,000 crore. So the making it while eligible for mid-market multinational entities. The margins for the IT/ITES sector have been reduced, and the sector has also now being consolidated. The IT-enabled sector, the knowledge process outsourcing, they all have been brought under the same umbrella. Similarly, the period for safe harbor applications have been extended to 5 years, which is a step in enhancing the tax certainty. The verification for safe harbor is IT/ITES sector is largely automated. So we hope that it will ease the compliance and simplify the process. And I don't want to overshoot my time. So this is bringing to the penultimate part of my address, and which I feel is the most important for the community I am addressing. because I believe that the tax administration and the CF fraternity are part of the co-parcenary ecosystem, and a law is only as good as it is implemented. So building a stable financial ecosystem requires an active participation of the tax administration with the chartered accountant community. While the tax administration is responsible for bringing in the right policy for a suitable technology and correct data and implementation of law, the cooperative trust is placed on the chartered accountant fraternity, whose verification, whose advisory and consultant role brings in compliance from our taxpayers, and which in turn can build a robust system of correct financial reporting. Over a period of time, we have seen that this ecosystem has undergone major shifts and dynamic changes, and this relationship has also changed from a traditional to a more dynamic, trust-based, peer-to-peer collaboration. While we as a department are committed to implement the words of our finance minister, which is trust first and scrutinize later in both letter and spirit, I believe that the responsibility for the building a modern tax ecosystem is on both the sides, and as we are co-authoring this transition. In fact, the ICI have contributed to the simplification of law by providing their recommendations, and some of them have been directly integrated into the new rules and the new act. As we all know that the chartered accountant community is actually the first gatekeeper for a clean capital, because all the data matching, the crunching, credit, the asset transactions, you are acting as critical filters. So you are the ones who are translating all this corporate complex data into accurate financial reporting, and the first gatekeeper for preventing a tax leakage before a return is filed. The tax administration plays its role as an enabler, and the department has shifted its focus towards simplifying compliance by providing smarter forms, pre-filled data, taxpayer information, and clear section-wise comparative mappings and guidance notes. So we would like to enable the fraternity to focus on strategic financial planning rather than navigating administrative hurdles. I also take this opportunity to reiterate the essence which has been the motto of the tax department, Kosh Mulo Dandaha. Treasury is the cornerstone of governance. A transparent, predictable, and simplified tax framework is the bedrock for economic progress. The implementation of this framework drives India towards its centenary goals in three major ways. And those three major ways I feel are, firstly, the formalization of economy, which is which has been enabled by technology through the compliance mode, through digital payment structures. Secondly, the boosting of ease of doing business. So moving towards a simpler law provides more legal certainty and a more conducive environment for capital deployment. Thirdly, building of the capital for social and physical infrastructure towards a Viksit Bharat, that has been the slogan of our Honorable Prime Minister. By shifting from the forced enforcement to voluntary compliance, the new tax regime therefore aims to expand the direct tax to GDP ratio substantially. As noted by Honorable High Commissioner also, we are partners in this march towards a nation of more resurgent and resilient India, as well as global partners towards a better world. Through this collaborative environment, the tax administration ensures systemic transparencies, and the professional community can ensure financial integrity, and the citizens can contribute to a robust pool of national capital. Coming to a conclusion, I leave the members of this esteemed gathering and fraternity reiterating the core spirit of the tax reforms and the regulatory reforms which are in furtherance of our shared objectives. Firstly, India is reforming, not reacting. So the transition from IT Act 1961 to IT Act 2025 and the rollout of tools like Karsathi are a part of a deliberate blueprint to build a modern fiscal framework which is rooted in transparency. Secondly, we value your contributions towards economic development and we are committed to providing certainty and clarity. We really value your feedback, and the department has reached out to the professional fraternity to obtain feedback so that we can update our FAQs, we can come up with more guidance note if required, as the approach is built on partnership. And Singapore especially has a special position vis-a-vis India because it is a premier source of the foreign direct investments, and they have always believed in the India's economic growth story. We hope that you place an unwavering trust in the shift towards our new tax and regulatory environment. We would like to hear and we would like you to share your practical feedback and your ground level implementation insights for bridging in any gaps that may lead to any ambiguity or confusion in the implementation of new law. And I'm sure this seminar will be immensely beneficial to all the professionals and the technical sessions which have been planned towards the later part of the program. And with these words, I thank you for your valuable time and our continued partnership. Jai Hind, Namaskar.
That one also half give.
Thank you very much, ma'am. Thanks for sparing your valuable time. Your insights will benefit to all the participants in their professional life. Now moving towards our technical sessions. Today we have two dynamic speakers with us today. We have privilege of having CA Rahul Gaurav Singhal sir, who is also a law graduate and tax expert with nearly 2 decades of experience in corporate and international taxation. He is regular faculty at ICAI, IFA, PhD chambers and several professionals forum and is widely respected for his practical and analytical approach towards international tax issues. And another speaker, CA Manoj Kumarji, who is holder of an advanced diploma in international taxation from the Chartered Institute of Taxation, United Kingdom. With more than 21 years of consulting experience, he has advised clients across technology, manufacturing, pharmaceutical, engineering, real estate, and several other sectors. His expertise spans entry strategy, planning, international tax structuring, corporate restructuring, litigation strategy, inbound and outbound investment, and regulatory advisory. With these words, may I now invite both of the speakers to kindly take us through the deliberations.
Thank you so much, Animesh. It's an honor to be a part of this August gathering. Heartfelt thanks and gratitude to Honorable High Commissioner Mr. Ambule and his office. Honorable CIT, Ms. Singh, thanks a lot for setting the stage so wonderfully with the entire background of how we are transitioning to the new law. CA Vishnuji, Chairman SciTax, CA Satish Kumarji, Chairman Singapore Chapter, CA Sanjay Gatani ji, and all the rest of the wonderful, extremely learned people. And special thanks to my wonderful friend, my co-presenter, CA Manoj. Manoj, with your permission, as discussed, I'm taking the lead with the first few set of slides. And when I will take up some of the lighter topics. The heavy lifting, of course, will be handed over to you, right? Thank you, thanks. So the outline of today's discussion, today's agenda is firstly, since we are talking about cross-border investments, then one of the biggest developments which are going to affect any cross-border investors, including therefore Singapore investors, is one of the latest Supreme Court decision in the case of Tiger Global. A lot has already been analyzed about this decision, has already been discussed about this decision. What we want to bring here is how will it affect the Singapore-based investors? Because otherwise this decision was in the context of investor located in Mauritius. We will then move on to the discussion on Budget 2026, couple of changes which it has made. a very recent amendment which has been made by the Income Tax Ordinance of 2026. What has been brought in by the new income tax law, although a lot has been explained about that by Honorable Ms. Singh. My friend will explain it in more detail, and he'll also explain in detail about the developments around GIFT City and certain few other key recent regulatory updates. As I mentioned, the first discussion is one of the biggest developments which affects the investor community, the cross-border investments all across the world into India. Because this development is about a debate which has been brewing for quite some time. And on this matter, the view has changed also over the years. The understanding has evolved. Essentially, we are talking about the question of whether or not the benefit of a tax treaty is available to a foreign investor merely on the basis of the argument that he has a tax residency certificate from that other country. Let me explain further. For example, a Singaporean investor invests into an Indian company. The law, as it used to be in past, was that that investor will enjoy a capital gain exemption of sorts. The entire allocation of taxing right in respect of those capital gains was that India will hold the right, Singapore will hold the exclusive right to tax those capital gains, and India won't tax it. But that was something which happened in past. This used to be important. This used to be an important consideration. Of course, any Singaporean-based investor, global investors, when they are setting up a presence in Singapore, will get the advantage of an amazing financial hub and an amazing investment community, private equities, VC funds, an ecosystem, a legal system. And in addition to that, the tax advantage which used to flow from the treaty between Singapore and India. Again, I repeat, what was the advantage? The advantage used to be that any gain on divestment by such Singaporean investor from his Indian investee entity will not be taxable in India at all. However, this position underwent some change. Like international tax laws evolved, India amended its treaty first with Mauritius and immediately thereafter with Singapore, where this benefit was restricted to only those investments which were made prior to April 2017. And this concept is what we call grandfathering. And later investments, that is investment made after April 2017, they would be taxed normally. For the first couple of years, there was a slight bit of relaxation. And of course, there was this introduction of general anti-avoidance regulations, because at some stage, in effect, that and in the absence of a codified anti-avoidance regulation, a lot of time it is not able to exercise its sovereign right to tax. With this background, what happened in the case of Tiger Global? Why is it so important? Let's first quickly look at the facts. In this case, essentially, this is about the entity which you see in the middle of the screen, TG Mauritius Funds, the taxpayer. This is an entity which was in turn held by other Mauritius entity, on top of it a Cayman entity. And then that Cayman entity was essentially a fund which had collected funds from, well, more than 30 jurisdictions, more than 250 investors. And this entity held shares in a Singaporean entity, the Flipkart Singapore entity. Flipkart Singapore in turn held Flipkart India. And an admitted fact, uncontroversial fact, was this was pretty much it. That means there was no other business, there was no other value creation, value driver of the taxpayer entity, the Mauritian entity. And these investments were all made prior to 2015, 2011, 2015. Somewhere in 2018, this taxpayer, the Mauritius entity, decided that it will divest its stake. Essentially, the idea was to sell these shares to Walmart. And here, the exact entity to which it was being sold was a Lux entity, a Luxembourg entity. Right. Now, with this background, the question arose that when the Mauritius entity will sell the shares of Flipkart Singapore, will there be a tax incidence in India or not? Why was this important? Because while the shares were that of a Singaporean entity, they derived their value, more than 50% of their value, from assets, operations, business located in India, which triggered the indirect transfer rule. And the question arose that at least under the domestic tax law, if it is taxable, can there be an opportunity, can there be a possibility of gaining an advantage, a tax benefit, which is given under the India-Mauritius Treaty? And with that question, first, this taxpayer, Time Global Mauritius, approached the tax authorities for a lower withholding tax, didn't succeed, and then approached the Advanced Ruling Authority, where again it didn't succeed. Fundamentally speaking, the reason why Advanced Ruling Authority did not consider this application was because it felt that the control and management of the Mauritius entity was not in Mauritius. Its actual head and brain was in US, and I'll tell you why. It then therefore concluded that effectively the Mauritius entity was a conduit company, didn't have any substance, economic substance, and therefore the question of it being a tax resident in Mauritius does not arise in spite of the fact that there was a tax residency certificate, TRC, which had been issued by the Mauritian tax authorities. So essentially, the Advanced Ruling Authority said that the real intention behind obtaining this TRC was actually only treaty shopping. To conclude, Advanced Ruling Authority felt that this entire structure was created prima facie for avoidance of tax. And this prima facie satisfaction is actually good enough under the Indian tax law for an Advanced Ruling Authority to reject such an application. However, when the taxpayer approached the High Court under a writ petition, interestingly, High Court took an opposite stand in favor of the taxpayer. The High Court held that, well, the way we look at it, the board of directors of this Mauritian taxpayer, it is carrying on all the decision making in a deliberate, in a collective decision making manner. So therefore, it is deciding. It is not deprived of any autonomy. It also felt that fine that the pooled investment vehicle is in Mauritius, but that's not such a big deal because after all, you need to have a pooled investment vehicle somewhere. And this structure was in existence for more than a decade. Therefore, it's not that it was created just overnight to create a tax avoidance tactic. No, instead, they felt that the company, the Mauritian entity, had an economic substance. It also commented that why GAR provisions will not apply general anti-avoidance regulations which had been incorporated in the Indian tax law. It finally said that the TRC issued by the Mauritian authority, it's sacrosanct, and therefore it should be respected. The entity should be treated as a Mauritian tax resident, and therefore should be allowed the advantage given the Mauritius tax treaty, almost the same advantage which was there in the Singaporean treaty also. That means no tax, at least for pre-2017 investment, which this investment was. Long story short, High Court held in favor, but the issue then traveled further to the Supreme Court, where some very peculiar facts were noted very closely. And first of all, let me highlight about those facts. These facts were about how a US entity, which was a fund manager for the Mauritian entity, the US entity, which had at its helm a gentleman, Charles Peyton Chase Coleman III, a gentleman who's about 4+ years elder to me, slightly richer than I am. He is the 581st richest person in the world with a net worth of about $6 billion. This gentleman was held by, factually speaking at least, this gentleman was stated as a beneficial owner in the application which the taxpayer entity had made in Mauritius for the GBL1 license. He was also the authorized signatory for this Mauritian entity for any transaction worth more than $250,000 US. A lot of other facts around the way the whole business was governed, decision-making was governed, was indicating that probably Mr. Coleman is the one who's at the helm of the affairs, and the problem was he was not in Mauritius. While the entity had Mauritian directors, yet in a lot of cases, it appeared first to the Advanced Ruling Authority, and it appears later on to the Honorable Supreme Court as well, that actual power of decision-making was vested with Mr. Coleman, who was located outside of the Mauritius. As a result, the end result was, and I'm not going through too much of details of why, because we'll discuss more about its applicability in the context of Singapore. So most importantly, what was held by the Honorable Supreme Court in earlier this year was that the sheer fact, the only fact that there is a tax residency certificate issued by Mauritius to the Mauritian taxpayer does not mean that the Indian authorities and the Indian courts are bound by it. that they cannot verify the actual tax residence. They can. And that was a starting point, because the moment the tax authorities are vested with the power to look at, examine, and maybe to disregard the TRC, the tax residency certificate, it also therefore automatically gave them the power to take away the benefits which are available under the tax treaty, because those benefits are supposed to be available only to a tax resident of Mauritius. Mind you, there were a good number of decisions in past. There were some circulars also in past, in which it was held from time to time. In the circulars, it was stated, in the decisions, it was held that the TRCs are binding. But the Honorable Supreme Court in this decision said that all those circulars and the decisions related to a time period when the amendments such as General Anti-Money Regulation had not been made in the domestic tax law. Now those amendments have been made, and therefore those circulars, those decisions are no more binding. A very important question, a very important question. As I mentioned, the Singapore Treaty as well as the Mauritius Treaty both contain a very, very similar clause that all the investments made prior to 1st of April 2017, they will not be challenged. They will not be challenged. And therefore, the capital gain arising on divestment of those investments, whenever made in future, right, even after 2017, that will not be taxable in India. The taxing right will only be in the resident state. In this case, for example, Mauritius. Then, why is it the tax authorities that they're still looking into it? Also, at some level, the question was, there is a GAR grandfathering. That means even under the General Anti-Money Regulation, there was a grandfathering concept that all those investments made prior to 1st of April 2017 should not be subjected to GAR provisions either. So the question is, can we still look at, can the Indian tax authorities still look at these investments which were made prior to 2017 from the GAR lens or not? Interestingly, the court first said yes, but then it also added that so what? We can probably also look at it from the lens of JAR, which is Judicial Anti-Money Regulation. Why this is important is because GAR is codified. So it has some premises, it has some parameters, right? It can't go beyond that. JAR, not codified, right? It's a philosophy which has been developed over decades by various judicial decisions. And at some stage, there was a conversation that because JAR are not codified, there's a difficulty in applying them, which is the reason why GAR, General Anti-Money Regulation, should be incorporated in the code, the tax code. Now that GAR has been codified, do JAR still apply, or now that the job of JAR has been transformed to GAR, JAR have no applicability? Interestingly, the Honorable Supreme Court said that JAR still continue to be available to the Indian tax authorities. Finally, an important question, the most fundamental question: what is the scope of a tax treaty? Is it to avoid double taxation? Is it to also allow non-taxation in a situation where even the resident country is not taxing the same gain? Remember, Mauritius, almost like Singapore, does not have the capital gain tax at its end either. Therefore, the question was, if Mauritius doesn't tax it, India doesn't tax it, that means there's double non-taxation. And is that something which is permissible or not? Well, the Supreme Court held that once it is proven by the tax authorities, and Supreme Court felt that it is proven, that the transaction in question is an impermissible avoidance arrangement under GAR, then the question of whether or not this transaction can be subjected to, can avail the tax benefit in the treaty does not even arise. Once it is factually proven, then Article 13, remember, the taxing provision which grants this tax benefit to the investor, is actually no more available. Also, mind you, if I bring you back to the structure that was under the question here, the shares which were getting transferred were that of a Singapore entity, not an Indian entity. Therefore, actually, this is a case of an offshore indirect transfer for which same provisions are there in the domestic tax law. Now, the question was that how would this be taxed in the treaty? And interestingly, the Honorable Supreme Court said that the treaty is not supposed to address this situation. And therefore, the treaty cannot be availed if the shares in question which are getting transferred are not that of an Indian entity, not that of a Mauritius entity, but that of an entity in a third state then the treaty should not apply. Which, by the way, interestingly, is curious because when the indirect transfer provisions were being introduced in the domestic tax law of India, at that time, the then finance minister had actually stated in a clarification in the parliament that the offshore indirect transfer provisions will not disturb, will not be affected by how the treaties are there and will not in turn affect the treaties. That means treaties will be supreme. However, in this decision, the Honorable Supreme Court held differently. One very important factor. The Honorable Supreme Court in this case said that it is for the taxpayer to prove that the transaction is questioned is taxable in the resident state, is taxable in Mauritius. And therefore, if the taxpayer can't prove it, which was a fact, because strictly from the perspective of actual tax liability, Mauritius had no such tax liability in the context of this capital gain because it chose in its domestic tax law not to tax it. So the question is, if there is no actual tax liability in respect of this gain, still will the treaty apply or not? And curiously, the Honorable Supreme Court said that once there's no actual tax liability, then the treaty will not apply. Now, this was a quick background. Right? A lot of things which were held in this decision, they made a lot of waves. The international investor community, they also looked at the decision with in fine prints, and there were a few things which stood out. For example, the applicability of GAR to pre-2017 amendments. Now, that was something in respect of which at some stage the Indian government had conveyed quite a good deal of comfort to the investor community worldwide that the pre-2017 investments, whenever divested, will not be subjected to GAR. But this decision did something different, damage control time, which is the reason why the provisions governing the applicability of GAR to pre-2017 investments, specifically speaking, Rule 10U of ITR 1962, Income Tax Rules 1962, and its corresponding rule in the new rules 2026, they were amended. Why? Two reasons. At some stage, it appears that the Honorable Supreme Court said that if the transfer has been made after April 2017, even in respect of the investments which were made prior to 2017, since the transfer has been made after the so-called cutoff date, therefore it will be taxable. GAR provisions will apply. Now, this was contrary to the original intention of the lawmakers, which is the reason why, with effect from 31st of March 2026, this particular rule was amended to clarify again that the investments were made prior to 1st of April 2017. Then, in respect of those investments, irrespective of when they are divested, when the transaction of divestment happens, irrespective of that, the GAR provisions will not apply. That's point number one. Point number two, there was also a distinction between investments, the transaction of investments, and the arrangement around it, which is a more nebulous word. So what I'm trying to say is, if an entity has made an investment on a particular date, but then the same investment is repeated, same pattern is repeated in future, then that arrangement which happens after April 2017, right, cannot be said to be based upon the same arrangement which was in existence prior to April 2017. Therefore, the other sub-rule, which at some stage was interpreted by Honorable Supreme Court to mean that the arrangement is what they will call this transaction structure as, and because arrangement was allowed to be tampered with by the GAR and allowed to be examined by the GAR rules under the sub-rule 2 of the same rule 10U. Therefore, GAR provisions will apply. This was also amended to clarify that fine, the tax authorities can look at any arrangement from a GAR lens, but again, only those arrangements which are not investments. That means the minute we are talking about the divestment of an investment, which itself was made prior to April 2017, GAR provisions will not apply. In a sense, basically, to a limited extent, this part of the Tiger Global Supreme Court decision, which had disturbed the apple cart, the old position is being restored by these amendments. So what is the current position now? as of now, and now I'm moving more towards how will it affect Singaporean investors. First, that if any shares were acquired pre-2017, then whenever they are divested, then so long as the tax treaty benefit is not denied, say because of the TRC related provisions, the Singapore Treaty also will allow a taxing right exclusively to Singapore, no taxing right to India in respect of those capital gains. I repeat, shares which were acquired, investments which were acquired prior to 2017, to be more precise, April 2017, whenever divested in future, they will enjoy the Singapore Treaty benefit, and therefore they should not be subjected to tax in India at all, provided, as I mentioned, the treaty benefit is not denied, provided the tax authorities feel, the courts feel, that this is not one of those transactions which should be sort of targeted by GAR, for instance, right? The other important part is, in respect of those shares which are acquired post 2017, I'm talking about indirect transfer. There were several decisions in past, not Supreme Court, the ones, other than that, in which it was held that indirect transfer of shares should not be targeted by treaty, should not be covered, should not be targeted by the domestic tax law. It should get a protection from the treaty. Now, in this context, the Honorable Supreme Court has reversed the position, and there's no remedial amendment so far about it, which means that any shares, whether acquired prior to 2017 or after 2017, if those shares are not of a company which is resident in Singapore, not of a company which is resident in India, and instead is a resident of a third country, but it is getting targeted by the indirect transfer provisions of the Indian domestic tax law, then will a treaty protection be available in respect of those shares? No. The Singapore treaty protection will not be available to indirect transfer if we read these Trigal Global decision, because it says that treaties are not subject to cover those shares which are not of a company which is located in either of the two contracting states. Now, with this background, the question arises that how does it affect the tax residents of Singapore in a direct transfer situation? First question. Remember, the entire discussion is about availability of the treaty benefit to an entity which is claiming to be a tax resident. So what do we mean by resident? And here comes a very important point. The definition of residence under Mauritius Treaty with India is very, very different from the definition of resident under the Singapore Treaty. Under the Mauritius Treaty, the requirement is that a Mauritian incorporated entity should be liable to tax in Mauritius to qualify as a Mauritian tax resident, and it should be so liable to tax because of its place of incorporation, domicile, etc. So the question was, in case of Tiger Global, can it be said that Tiger Global is liable to tax? Now, mind you, liable to tax has now been defined in 2022 prospectively, but the Tiger Global decision was for an year prior to 2022, right? And therefore, the definition of liable to tax, which was there in the domestic tax law at the time of pronouncing the decision, was still not relied upon because it did not relate to the year, right, in which the transaction had taken place. This decision, this definition very clearly says, which is there in the Income Tax Act 1961 as well as in 2025, that liable to tax will also cover a situation where a person has subsequently been exempted from such tax liability under the tax law of that country. For example, when the Singaporean entity is liable to tax in respect of even its capital gains in Singapore, but it has been exempted, say because of Section 13W, right? It has been exempted from that tax liability in Singapore. So that means the Singaporean entity can say that even if the Tiger Global Supreme Court decision said that the taxpayer will have to prove liable to tax, here we are liable to tax because the definition of liable to tax says that so what, that we have been subsequently exempted. It explicitly says so long as there is a legal provision, legal machinery to tax these things, and later on we have been exempted, we are still liable to tax. But the point that I'm trying to make is, will a Singaporean investor even be required to do so? I don't think so, because personally, I feel that the liable to tax definition, which was there in the Mauritius Treaty, is actually not there. in Singapore Treaty. So what does the Singapore Treaty say? Singapore Treaty simply says that a resident of Singapore means any person who is resident in Singapore in accordance with the tax laws of Singapore. End of story. Right? So the liability to tax condition is not something to be proven by a Singapore tax authority, at least if you look at in a prima facie manner the definition which is given in the Singaporean Treaty. Secondly, while the residence test may be met, mind you, all Singaporean investors will still have to satisfy the limitation of benefit test, Article 24A, which is there in the Singapore Treaty, which basically says that if the primary purpose of arranging the affairs, that means of the whole transaction structure, of the whole holding structure, was to take advantage of the treaty benefit, then that treaty benefit will not be available to such a Singaporean investor, right? Mind you, there is another clause which talks about shell companies and when a company will not be deemed to be a shell company just because it has an operating expenditure of more than 200,000 Singaporean dollar, but that's independent of the first clause. What I mean to say is that a Singaporean entity may be incurring more than $200,000 per annum of operating expenditure, and yet if the tax authorities are able to prove that the primary purpose of creating that structure, of arranging those affairs, was to obtain the tax advantage, the treaty benefit in respect of those capital gains, then the LOB clause, limitation of benefit clause, may kick in, and therefore this tax benefit may be denied to the Singaporean investor. Another way where a Singaporean investor will still be targeted for taxation in India, therefore will have to make sure that it passes this test, is a principal purpose test. It's a very interesting test introduced in a lot of treaties thanks to the BEPS initiative, the BEPS project, which was spearheaded by OECD and Inclusive Framework. And through Action Plan 15, it has been incorporated as a multilateral instrument, through multilateral instrument in a lot of treaties, including the Singapore Treaty. And this test also says that notwithstanding any other provision of the treaty, any benefit which is there in the treaty will not be granted if it is reasonable to conclude by the tax authorities and the courts that obtaining that benefit was one of the principal purposes of that arrangement. Mind you, this is important. GAR provisions don't say one of the purpose, right? The limitation of benefit clause also says a primary purpose, but the principal purpose test says one of the principal purposes. There can be multiple purposes. One of the purposes was to merely obtain the tax advantage, effectively treaty shopping, and the treaty benefit will be denied. Mind you, grandfathering of the pre-2017 investment will be protected from the GAR provisions, will be protected from the PPT, principal purpose test. So therefore, in respect of principal purpose test, there is a leeway. For the limitation of benefit clause, there's not so much of a leeway. And as I mentioned, the amendment which has been made is also in respect of GAR provisions. Amendment that has not been made in respect of specific anti-avoidance regulations and judicial anti-avoidance rules. I'll pause here for a second because I've been rattling on. Manoj, I really would want you to pitch in. You have an immense experience of dealing with these kinds of transactions, and I would love it if you share the same. Please.
Thank you, Gaurav. I think you're really covering this in as articulate a manner as you can. While you've outlined a lot of these aspects on the treaty benefit potentially still being available, and the complications related to it. While in a way GAR position has been reinstated, it still stands the test of the principal purpose test and the LOB condition. This applies in the context of a simpliciter investment by a Singapore entity into an Indian entity. We may also see this unfold very soon because a matter of this sort is before the Supreme Court in the case of Blackstone's investment that was made from Singapore into India, where a treaty benefit under the Singapore Treaty was challenged by the revenue, and the Delhi High Court has upheld the treaty benefit. That matter is now before the Supreme Court, and we should shortly see how the Supreme Court looks at it. over and above a test on, investment in the form of shares, the complications get even further if we deal with instruments such as compulsorily convertible debentures, because they potentially don't fall under uh, 13.4, the article that is, dealing with shares, and they potentially fall under the residual article 13.5. In case of indirect transfers, again, like you mentioned, there is a further complication on account of the way in which the Supreme Court has read the India-Mauritius Treaty on non-applicability of the treaty in the context of indirect transfers. In case of other kinds of instruments, which may be, say, investments in REITs, the complications get further. So while the CBDT has put back the position in respect of GAR, there are other observations of the Supreme Court on JAR, on the substance arrangements, which still continue to haunt the potential treaty benefits that can be claimed. Sorry, you're on mute, Gaurav.
So I have to make that mistake once a day and my target is achieved. Thanks, Manoj. That was really helpful. I'll just quickly take the audience through a couple of more slides and then I'll hand over the baton to you, Manoj. There's a development which actually happened, last year in the Singaporean tax law. As we are aware that Singapore generally doesn't tax capital gains on sale or disposal of any, foreign assets, or which includes shares, right? But at some stage, inspired by the EU regulations and so on and so forth, Singapore introduced Section 10L, which basically says that if a Singaporean business, if a Singaporean, equity holding company lacks adequate economic substance in Singapore, then if it earns any gains from sale of any shares, in a company, say, outside of Singapore after January 2024, then those gains will not enjoy the tax exemption under tax laws of Singapore. Therefore, Singapore will tax it. Again, I repeat, the only way a Singaporean entity will avoid paying taxes legitimately in Singapore on those gains is if it qualifies as an excluded entity, which means basically that it will have to meet substance requirements. Over the last, 1.5 years or so, the revenue authorities of Singapore have been issuing rulings, advanced rulings, and their summaries in which they are explaining how will these provisions apply, in different contexts. So the last two latest rulings are ruling 2026, ruling 2 and ruling 3. Their summaries were released on 2nd of January of this year. And they have both dealt with a non-pure equity holding entity. So basically a pure equity holding entity is an entity which is earning only dividend income, right? And therefore, since it's a purely passive entity, the substance test in that case is slightly lesser, whereas a non-pure equity holding entity means it's an entity which is earning, mixed passive income streams, right? And therefore, it has to meet a slightly higher, substance threshold, which you can see right now in the middle of the screen, the second one. Why am I talking about Section 10L of Singapore law when the subject matter is tax implications in India? Well, imagine a scenario where a Singaporean investor entity, whether a pure equity holding entity or non-pure equity holding entity, right? When it fails this substance test, because of which Section 10L gets triggered, because of which Singapore taxes this game. The important thing to be noted is how will it affect India tax implication, because it will be very easy for the Indian tax authority in that case to take a position that when the Singapore IRAS is itself taking the position that this entity lacks adequate economic substance in Singapore, can this entity, in fairness, in light of GAR provisions, in light of limitation of benefit provisions, avail any tax benefit under the Singaporean treaty or not? So what I'm trying to say here is, even Section 10L of Singapore tax law will probably have a direct impact on how Indian tax authorities will view the eligibility of such an entity, a Singapore entity, under the India-Singapore Treaty, how will they view its eligibility for this kind of an advantage? Manoj, over to you, my friend. Just let me know when you want me to skip to the next slide, and I'll keep doing the task. Please take over.
Sure. Thank you. In the interest of time, I will just move a little quickly through these provisions, but maybe we can go right into the topic. We've also now covered a couple of other amendments that were relevant in the budget. The one that is now on the screen is on taxability of buyback. On this, there's been a slight flip-flop by the government in a sense on the scheme of taxation. While originally, buyback was taxed in the hands of the shareholders, then the government moved the taxation into the hands of the company, and it was taxed initially as deemed tax in the hands of the company that was carrying out the buyback. A couple of years back, the government then altered that scheme, and a provision was introduced to deem the amount of consideration paid on buyback to be dividends, and the consideration being paid on buyback was taxed in the hands of the shareholders as dividends. While there was no benefit that is being provided in respect of the cost base of the shares, it was the cost base of the shares was deemed to be a loss that could be recorded in the hands of the shareholders. Now, that of course created a lot of ambiguity, particularly in the case of non-residents holding shares in the hands of an Indian company. And there was a potential view on whether buybacks carried out by non-residents could still be considered and could be evaluated under the capital gains tax article in the applicable treaty. However, with this amendment, what the government has done is has changed back the treatment.
ये चालू हो गया call.
They have changed back the treatment on buybacks back to capital gains like it was before. However, what the government has done is to avoid the potential abuse of this path of cash being distributed by the company to the promoters in the form of buybacks and paying a lower rate of tax. They have said they have applied the rates that are applicable to non-promoters are outlined 20% for short-term capital gains for residents and for domestic and foreign companies as well. And for short-term capital gains, it goes up to 30%. For a domestic company, 22%, and for a foreign company, up to 35%. So for a long-term capital gains, it goes up to 12.5% for non-promoters. If you go ahead, now for promoters, of course, the tax rate is higher, given that this was not meant to be an artificial way of declaring dividends. The rate of tax goes up to 22-30% based on the nature of the company. For foreign companies, 30%, and for individuals as well. Promoters are, of course, defined as under the SEBI regulations as they're applicable for listed companies, and for unlisted companies as they are defined under the company law, or the ones that are holding more than 10% shareholding directly or indirectly. If we go in here. So the other amendment that we wanted to cover is in relation to options and securities. Of the option premium, the STT rates on these have gone up. Again, with the government had made it clear. I think there was a lot of press and a lot of noise on a lot of retail investors losing money by speculating and by trading through options and securities. With their intent to, in a way, curtail that channel, the government has increased substantially the rate of STT that is applicable on futures and options. We can go ahead from here. Going ahead, Gaurav, do you want to cover the ordinance?
Sure. It's a very brief development, which is with effect from 1st of April 2026, and this is in a sense slightly retrospective because the ordinance came out much later, in May 2026, but with effect from 1st of April 2026, and an exemption has been extended the exemption has been extended basically with the idea to sort of encourage FIIs to invest in G6 government securities in India. So the eligible taxpayer, therefore, which are the subject matter of this ordinance, this development, are FIIs, which means basically semi-registered FPIs, and the Swiss bank, the Basel headquartered bank of international settlements. The income in respect of which this ordinance says that there'll be an exemption which will be offered to them is twofold. A, the interest income from these government securities, which are basically securities issued by in central government or any state government. And also whenever they exit from these securities, they sell the security, then any capital gain on these investments is also exempted. In the context of Singapore Treaty, because the government securities are not covered by any of the other paragraphs of the Article 13, which taxes capital gain, therefore they get parked under the residuary paragraph, which basically anyway gives the taxing right, exclusive taxing rights, only to Singapore, and therefore India has no taxing right. Therefore, as such, in a very fair world, the second part, which is the exemption to capital gain, does not have any significant relevance to Singapore investors, except to the extent that now that this exemption is built into the Act itself, the investors into government securities will not have to bother with getting a TRC and so on and so forth for the purpose of availing this exemption, because they are not going to be availing this exemption under the treaty, but instead under the Act itself. Back to you, Manoj.
Sure, thanks. On the overview of the new tax law, I think Kalpana ma'am did cover a large part of it, but I will just quickly reiterate some of the relevant areas. Again, the overall intent has been simplification. That's the theme with which the government has really brought about this legislation, and kudos to the government to have achieved this really in the amount of time and really meeting the objective that they have called out. The law, of course, the new law contains a lot of structured tables and formula in a form to make it far more easier to understand and implement the rates that are being called out, such as the withholding tax section that just tabulates the entire applicable provisions and their related applicable rates. If you just stay back for a minute, Gaurav. Tax here, of course, has been the terms such as explanations, provisos have of course been done away with. All of those explanations, provisos have come back into specific sections, and the ones that were obsolete have been taken away from the legislation. The tax year concept replaces assessment year in previous year, like we said. This is already covered, 536 sections that are there with about 16 schedules. The volume is therefore far, far lower. The new forms, like ma'am had mentioned, are smart forms. A lot of data in those forms get pre-populated. I think there's a flip side. We have had issues with data that is pre-populated that is incorrect in many ways on account of sources not being corroborative or having reasons to differ. How to deal with those situations will be a matter that we'll have to see, and what kind of explanations will have to be provided. So as taxpayers, we'll have to watch out on these forms, on the data that gets populated, have reconciliations in the background, make appropriate disclosures, and see that it doesn't come with unwanted consequences. The good part is, all the laws that are applicable for financial year and all the filings that are applicable for the financial year 25-26 continue to apply with the old forms. So the tax audit report and the ITR filing, this year's compliance will all go with the older forms. And only for the financial year 26-27, the new forms will take effect as and when their compliance will become applicable, which gives some time, because the new The tax audit report also has additional requirements and additional disclosures that have brought in. Like ma'am also mentioned, the Form 3CB has been completely revamped and asks for a lot more data. It is important for taxpayers to get geared up to be able to compile this kind of information and put it into the forms in time. And if we don't prepare early, grappling with this really at the time of filing is going to make it difficult. And therefore, it is advisable for all taxpayers to spend some time on looking at preparedness for the compliance for 26-27 before it comes into play. You can go ahead, Gaurav. We've just picked a few forms relevant from an international tax perspective. The Form 15 CACB has got replaced with Form 145, 146. Largely similar, while more disclosures required in terms of the tax identification number, country of residence. Like ma'am made a mention, the UDIN has been brought into the form itself, and the acknowledgement number has to be mentioned in the form. The form asks for details of the remedy and various other verification details, which is tax identification number, country of residence, and further details in relation to a lot of the forms have this feature of more KYC related details being updated. In this form, earlier, while the capital gains, while the remittance amount would be provided, there is also a requirement to provide the capital gain working in Form 146 that also needs to be provided. And the CA in a way has to certify all the particulars being true and correct. And this also is a feature that is running through various forms. Therefore, chartered accountants certifying these forms have to be far more cognizant and have to be cautious about the certifications that are being carried out. The law also contains some penalties for incorrect particulars, and that's what chartered accountants should be careful about. Going to the next form, this is Form 41, equivalent Form 41, 42, 43, or really an equivalent of Form 10F. This was a form that was in a sense optional for non-residents to provide in case the particulars that were required to claim a treaty benefit were not available in the TRC. Now it is made mandatory anyway for non-residents to provide the Form 41, which was equivalent of earlier Form 10F. Every non-resident should provide it. Now on this form, again, some details have gone up in terms of contact details of the non-resident that need to get included in this form as well. The verification, of course, language has been slightly beefed up. The other one thing is at this stage, it says that this Form 41 can be filed once a year, and that's what is stated in the FAQs. This does bring about a practical challenge because generally non-residents obtain their respective TRCs on a calendar year basis. And if you take, for example, the financial year 26-27, for which an Indian payer would require a Form 41 from a non-resident, and let's say the non-resident is in Singapore, then the Singapore resident would have obtained a TRC from the IRAS only for calendar year 26. So while filing the Form 41, they would only attach their TRC for calendar year 26, which may not be complete. Therefore, what we are doing currently as we are assisting companies, we are filing a note asking for the ability for the foreign company to update this form once they obtain their TRC for the calendar year 27. But that is something that you should be aware of and take into account this as these filings are being currently dealt with. We can go ahead, Gaurav. The other one aspect we thought we'll bring about is interpretation of tax treaties. While largely it remains the same, one aspect that has been brought about in the new law is that terms that are not defined in the treaty or in the act and there is no notification issued, those they can derive their explanation from definitions that are provided under any central law or any other law in the country. While this seems like a minor amendment, this may have an impact, according to us, on various aspects that have been dealt with by court judgments. For example, Supreme Court has in the past dealt with software payments in the case of engineering analysis, and has dealt with the definition of royalty under the Act and the treaty. And in that context, they did rely on definitions of copyright, literary, artistic, and other rights under various other regulations, including foreign regulations. Given this amendment, potentially, we, after looking at the definition of royalty under the treaty and under the Act, the other terms such as copyright, literary, artistic forms, all those definitions can be derived from a domestic law. Like under the copyright law, a lot of these terms have also been defined. So that kind of an interpretation will have to be dealt with now, given the new context. Even in various other cases in respect of investment from Singapore into India, for example, the terms shares, equity, CCDs, all of these are not defined, and if we may have to go back to definitions under the domestic law, there may be other regulations that define these terms, and we may have to take those into account while determining the treaty positions. So we can go ahead from here. Okay, I think those were really the provisions related to the new income tax law. We're switching gears just to cover some relevant areas in the context of GIFT City. GIFT City, of course, has been the government's favorite initiative since it has come to power. They have been doling out incentives to bolster the presence of, companies in GIFT City and to make this an attractive place even for funds and for pooling of funds. In this budget itself, the government has made significant announcements. They have doubled, in a way, the tax holiday period that is available to units that get set up in the GIFT City from earlier of 10 years out of 15 years. Now the tax holiday period for units in GIFT City is 20 out of 25 consecutive years that the unit may choose. That is applicable from 1st of April 2026. They have also made two other amendments, again, to be cautious about. Deemed dividend provisions were, in a way, exempt for certain transactions carried out by IFSC units. The budget has curtailed that exemption only to transactions that are carried out by a GIFT City unit and by a unit located with its entity located outside India, provided, of course, the parent entity is listed on a stock exchange outside India. So it applies, in a way, to outbound transactions. We'll have to look at it closely in relation to inbound structures and look at the facts and circumstances under which those, if it could be excluded. They've also brought about restructuring and splitting up conditions that will also apply to GIFT City units, saying a unit commencing operations after April 1st, 2026 will have to prove that it is not set up by splitting up or restructuring or reorganizing a business already existent in India. While this may be more relevant to the TechFin, the BATF units, we may also have to look at it in case treasury centers are being set up. With this queue, if we can just go into the next slide. Most of this we have covered. The 20-year tax holiday is known, like we said, has been increased from 10 to 20. The other significant advantage in the GIFT City is interest and capital gains. The interest earned by non-residents out of monies invested in the GIFT City is completely exempt. That is the single largest advantage that non-resident investors are looking at to be able to potentially channelize their monies that are targeted into Indian entities through the GIFT City. But this is applicable in case of interest. There are also exemptions for capital gains on transfer of specified securities by non-residents. MAT again is applicable at the rate of 9% and nil if a concessional rate is adopted. On dividend paid by GIFT City units to non-residents, they are taxed at 10%. This is in a way beneficial depending on the country from which the non-resident is investing, but it is competitive relative to various treaties that India have, and therefore even holding structures through GIFT City are being evaluated by various companies. Of course, there are no GST and so there are GST and customs concessions as well. Now, given all of that in the background, what we have been seeing companies evaluate, and this operates very closely in a sense with Singapore. Companies have been evaluating one of the important channels and one of the important regulations under the IFC regulations is the Regional Treasury Center or the Corporate Treasury Center regulations, under which an Indian MNC or a global MNC can set up a treasury center in the GIFT City, either for inbound investments or for outbound investments. In a way where a lot of funds have been pooling money in Singapore and have been investing money into India. After the domestic AIF regulations came out about 7-8 years back, we've had a plethora of funds set up domestic AIFs in India as well for investments into the country. We are seeing a lot of them now also set up AIFs in the GIFT City, and now they are also potentially looking at these treasury centers. So in a way, it allows all the private equity funds to have an alternative channel, or let's say an additional layer through which they can make their investments. The other one relevant area is also re-invoicing center. This is like a new concept that has got added into the Treasury Center regulations that's happened a few months back in April 26 itself, where the regulations allow an Indian company set up a re-invoicing center in GIFT City for the purposes of their shipping or for the purpose of their sales to overseas entities. Typically, again, we have seen, either Singapore or for in some entities in Middle East, in some cases that get considered or are the re-invoicing centers that are normally dealt with. Now, potentially a GIFT City unit can be looked at as a potential re-invoicing center where you do a bill to the GIFT City re-invoicing center and a ship to happens directly to the customer. The GIFT City unit then settles the transaction with the Indian entity, and then either with its own funds or by obtaining, financing at the GIFT City level itself, and then it then collects the consideration from the overseas customer. Potentially, the GIFT City unit enjoys a tax holiday for the margin and the operations that it carries out. So a lot of thought process will have to go into this, depending on fact patterns, depending on what business is what group engaged in. But these are all the newer opportunities that we see are coming up in the India-Singapore context and other foreign investor context as well. TechFin opportunity got opened up again last year while the government revamped the entire TechFin regulations in the GIFT City. They have eased out and expanded the scope of activities that can be carried out, both TechFin, FinTech, and in a way the sandbox activities. We have seen some of the large corporates who have started setting up their GIFT City units and have started ramping up their capacities to render these services to non-residents. Of course, these units will be entitled to a tax holiday that is available at the GIFT City. You can go ahead. BATF has also been there for some time. BATF means banking, accounting, taxation, and financial really activities. These activities also, if carried out in the gift city, are entitled to a tax holiday. The requirements are pretty much standard, with some substance requirements that are required. And what would have been otherwise required in case, let's say an SEZ, an STP, an EOU, many entities that have looked at tax holidays that would have been required to have satisfied if they were set up in India and they would have claimed tax holidays. Similarly, now that can be done if the entities are setting up this presence in the gift city. We have seen companies struggling with their ability to get talent around the gift city. That seems to be an area of challenge, but the regulatory framework and the infrastructural framework seems to be up and ready at this stage. I think this is what it was. Now, in the interest of time, there are a bunch of regulatory updates we have. I will just quickly go through them. In the last 1 year, while on the tax side, the government has made a lot of changes with an intent to simplify. The government has also carried out a large number of regulatory changes to simplify the exchange control framework that entities in India are operating under. The entire export of goods and services regulations have been revamped, and the draft regulation was put up about 7-8 months back for public consultation. And this regulation now has been notified and will be applicable from the 1st of October 2026. It significantly simplifies the current framework under which the export-import regulations do operate. Gaurav, if you can click on the annexure that is mentioned there, a few important ones, just down on the, yeah. So some of the headline simplifications, the export proceed realizations were from 9 to 12 months. They've increased to 15 and 18. Actually, very last week, the government has further reduced this back to 9 months more with an intent with their eye on the foreign currency accumulation that needs to be there in India, while the regulation has changed this to 15. Last week, the RBI has again amended this and brought it back to 9 months. The export form declarations, Softex was earlier filed with STPIs and with other authorities, and SDF, EDF forms were filed for goods. Now there's a single form, EDF, that is required for goods and for services, and the specified authority has been outlined clearly. It no more needs to go to STPI. And the EDF form for services needs to be filed within 30 days of the service, and it can be filed for multiple invoices that may be carried out during that period. It's important for all exporting companies to take note of all of this and to start complying with these regulations. The advance for import, the import settlement payments, the regulations for writing off or reduction in export value have all been simplified. Most of these have been delegated to the authorized dealer, and the authorized dealer is supposed to take a call on the genuineness and the bona fides of any of these arrangements, and a potential reduction in export value can be approved by the authorized dealer. So it does empower the authorized dealer significantly, while the authorized dealer has been tasked with an obligation to verify the bona fides of a transaction. We can go back. The other amendment in relation to the FDI policy is the PN3 update. I will just quickly skip that. On the press note 3 on investments that are made from land bordering countries, government has simplified or has outlined the process, has said the check will be carried out at the first foreign investor level. The beneficial owner definitions are aligned with the PMLA rules, which outline how you should look at beneficial owners. The press note now says that for investments sub 10%, it will be under the automatic route, even if without a controlling stake, provided, of course, the investment doesn't carry any controls that are related to it. And the other investments will go through an approval route. For strategic investments, in particularly in identified areas such as electronics, electronic components, etc., the approval will be processed within a period of 60 days. So it's a far more time-bound process for the areas in which the FDI is sought. We can go ahead. ECB regulations have also been revamped and simplified. The end-use restrictions have been expanded. ECB is now pretty much in line with the FDI policy, particularly in the areas such as real estate. There were a lot of restrictions on end use for ECB. They have been completely opened up. You can take ECBs in INR or in foreign currency. There's a lot more flexibility that has been brought out under the regulation, and it can be swapped at a point in time when the investee or the recipient of the ECB wants to change. The filing requirements have been streamlined, and a late submission fee has been introduced. That's an important one to take note of. It is important to see that the reporting requirements, ECB1 is for obtaining an ECB, and ECB2 is for utilization of those funds. It's important to see that all the filings related to ECBs are carried out by companies who obtain these loans. Similarly, guarantee regulations have also been in a way revamped and have been notified. A lot of definitions have been introduced and have been clarified. It does apply to any person who is transacting with a non-resident, and either the non-resident is a principal debtor or a principal creditor or a surety under a guarantee arrangement. In all of these circumstances, a reporting will have to be made with the authorized dealer. And the forms for there are separate forms that need to get filed, GRN, at the time of issuance of the guarantee, at the time of any modification of the guarantee, at the time of invocation of the guarantee. All of these are circumstances under which filings have to be made. Failure to make the filings do come with late submission fees, which are quite stringent based on the quantum of guarantee. Therefore, it's important for companies to take note and to see that these filings are complied with. We can go ahead. Receivables, I just covered that the time limit for realization of export receivables while under the export and import regulations was extended to 15 months. That has been curtailed back to 9 months last week by the RBI. I think with this, I do come to an end of the updates that we wanted to take you all through. We hand it back to here.
Animesh,
Hi,
you have to take
I
over.
guess, Animesh, are you there? Animesh? I guess I don't see Animesh over here. Kushal, I would suggest if you can come up with a vote of thanks.
Sure, Sanjay ji. Okay, hello everyone, dignitaries, speakers, our Honorable High Commissioner of India and Sanyamji, everyone present. It is my privilege to offer the word of thanks on behalf of ICI Singapore chapter and International Taxation Committee of ICAI. I'm Kushal Jaju, Vice Chairman, ICI Singapore chapter. Our deepest gratitude to His Excellency Dr. Silpak Ambule sir, High Commission of India to Singapore, for making time to present today with all of us and sharing the nuggets about the taxation challenges and the roadmap ahead. Thank you to our Honorable President CA Prasanna sir and Vice President CA Mangesh Kinare sir for their time and their commitment for our growing our professions across the borders. We are honored to have presence or special address by CA Kalpana Singh, the Commissioner of Income Tax, who has added the depth to our conversation today. Sincere appreciation to speakers CA Gaurav Singhal and CA Manoj Kumar for making the complex topic of this new Income Tax Act genuinely with a clarity and accessible to all of us, and CA Animesh Mangal for keeping it on time, and thank you for the excellent moderation. I would like to give warm thanks to CA Satish Kumar Gupta sir, President or Chairman International Taxation Committee ICI, and CA Vishnu Kumar Agarwal sir, Vice Chairman International Taxation Committee ICI. A big thanks to CA Vishal Tibrewala, CA Prachi Jain, and Sanjana, as well as the tech support OM for managing the webinar at the back end. Thank you, CA Sanjay Ghattani ji, Chairperson ICI Singapore chapter, for your vision into at ICI Singapore, where we believe that geography should never be a barrier to professional connection, networking, and growth. With this, I would like to thank each and every member, everyone who has made time and join us today for this webinar. And I was told in the messages that we had crossed the number above 450. Correct me if I'm wrong.
550.
500 plus. Yeah.
500 plus numbers that we have reached today. So thank you to each and every one of us who have made time to make it today. With this, over to you, CA Animesh Mangal.
Thank you so much, sir. With that, we conclude today's webinar. Thank you once again, all of esteemed dignitaries, speakers, and participants. Stay safe, healthy, and continue learning. Jai Hind, Jai ICI.
Gaurav and Manoj will connect separately on this. And if you can please help Animesh, if you can take the presentations from Gaurav and Manoj, and if you can share it with the participants. Huh?
Sure, sir.
There
Sure,
are
sir.
many requests from Singapore-based participants to share this beautiful presentation. Thank you so much, Gaurav. Thank you, Manoj. Thank you.
Thank you.
Thank you so much.
Thank you.
Recording stopped.